since prior to the COVID-19 pandemic. So we've got a tab to generate our history for our P&L, and then we've also got a balance sheet which is required, which is the balance sheet at the same date of the most recent month of the accounts. So I've got my history of my P&L, and then up to a point, and then at the same point I've got my balance sheet. And the balance sheet is in a similar format, whereas your first column are your balance sheet nominals, and your second column are your balance sheet balances for those nominals. Then all you do is you take the next two tabs and you just paste that information in. So my P&L nominals go in my first column, and my values go in the next column, starting again with the most recent month on the left and then going backwards. I then tell the model which month is the most recent month, and it will just work back from there. So if I've got April, so I selected the wrong year. If I've got April as my month, then I would just select April from that list. We're going to stick with March for the moment as being our most recent month, and then I just paste in my history going back, and it will automatically assign a label to that column being the relevant month. That once I've pasted in my balance sheet with my nominals, all I then need to do is assign that nominal to a category. And again, if I'm unsure, I've got a tooltip above which says select the chart of accounts category next to each P&L nominal, being sure to exclude any headings, subheadings, and totals. These should be left as select category. So really, really simple. What do I need to do? I'll just hover over the column. It'll tell me what I need to do. So these are my sales nominals. So I've already categorized those as sales. These are my cost of sales nominals, and I've already categorized those as cost of sales. And guess what? These are my overheads, and I've classified those as overheads. So that's all I need to do. If for whatever reason I have a nominal which is appearing in a section and I want it to appear in another section, so if I wanted travel and subsistence to be treated as a cost of sale and therefore roll up into margin, I could just change that to cost of sale. I would argue you should go back and change your chart of accounts within your accounts rather than doing it this way, but you can manually change it this way. But we'll change that back for now. So that's how I set up. So simple as that. Exclude all of the totals and headings and just categorize the nominals themselves. And then for the balance sheet, exactly the same. In most instances, you'll download a P&L and a balance sheet, and they'll come in a prescribed format anyway. And they will generally, for the P&L, will generally follow sales, cost of sales, overheads, and the balance sheet will generally follow fixed assets, current liabilities, long-term liabilities. Therefore, it'll be pretty obvious what category I assign to the nominal. Again, here, these are my fixed asset lines. I'll just assign all of those nominals as fixed asset, and being sure to exclude the total and also any headings, because we don't want those to pull through to the model. The only other thing that I probably need to note on the balance sheet is if I have any floating nominals, i.e. nominals which are either a current asset or a current liability dependent upon their balance, I just classify those where they ordinarily would sit. So the example I use is if I've overpaid on VAT, and actually I've got that as a floating balance, and that appears up here, then I would just select that as a current liability. So regardless of where it is on the balance sheet that you've printed off, you can select where you want it to be labeled by selecting that blue cell and the drop down within that cell there. Now, so that's how we upload the data. However, through X5's portal, anyone that's on Xero, all of that heavy lifting work is just done for you. And actually, you're just presented with a model which starts with this baseline forecast here. So all those tabs at the start are for those businesses that require manual entry and that aren't on Xero. So that was just briefly how I get the information within the model, and then the model is exactly the same whether you're on Xero or not for every business going forward. So the scenario that we're going to use, an event management company as a scenario, because it fits quite well with regards to the pandemic which is going on at the moment. And what we're going to show is we're going to show a baseline forecast. Because when you apply for funding, what funders generally want to understand and know, well, not generally, do want to understand and be able to quantify, is the impact the funding is going to have on your business. So I set my baseline, and my baseline is what is going to happen in my business. What do I know to a certain degree of comfort is going to happen in my business going forward? So as an example, we're closed for the next 3 or 4 months. Well, we know we're not going to generate any revenue over the next 3 or 4 months. So your baseline is about what do I know and what my planning is going to happen in my business over the next 5 years. And then you overlay on top of that your funding scenario, which talks about the impact the funding has on your baseline. And I'll come on, and hopefully that will become apparent when I come on to those tabs shortly. So essentially what we've got is the scenario is you've got an event management company that is going for a period of time where we're doing very little revenue over the next 6 to 12 months, and we're gradually picking our sales back up after that period of time. Therefore, we are applying for a loan to satisfy a deficit in cash flow. But what we're also going to do is we're investing in virtual event management software, which hopefully will generate some income over the coming months. So that's the scenario we're using. So you open up your model, you paste in your history, and the first thing you do is you calculate what your baseline forecast is, i.e. what is, as I've said, what is going to happen in my business going forward. The first thing you're presented with is the last 2 years worth of history by month, for which to establish some sort of baseline. Now the model itself will calculate what's happened over the last 2 years. It'll provide some year-on-year analysis. As you can see here, we've got all of the nominals. So any sales nominal, or it depends how your business operates, whether you record it by customer or by nominal. But that will be presented here. So if you only operate off one nominal as a business, well, you'll only get one line. If you operate off multiple nominals, you'll get multiple lines down the left-hand side. And then what you're doing is you're saying, okay, well, in this instance, because we've been really imaginative, each one of our nominals has increased by 5% year on year. And then we are presented with that variance by quarter. So I can see for this particular line, i.e. sales nominal 1, I've done 215 grand over the last 12 months, which was a 5% increase on the previous year of £205,000. And in each of the last 4 quarters, I've generated a 5% uplift year on year. What you'll be presented with then, now I've pre-populated some of this for speed, but the top line is as per you will find it within the model. What we then need to think about is, okay, well, the forecast going forward. So what you're presented with is the equivalent of this top line for every single line. And what it does, it says, okay, what has happened on this nominal over the last 6 months? Now, as we can see, we've had a 5% increase in October to December and a 5% increase in January to March. Therefore, my last 6 months has delivered a 5% increase. And then what it does is it just applies that going forward. So it maintains a seasonality from the previous year, and it applies a 5% uplift by month to each of the months in the following year. So what I've done with all of the other lines, and I'm just going to copy this up for this line, is I've essentially put in my assumptions for what's going to happen for sales. Now, the first thing I did was, well, we've got no business whatsoever for the next 3 months. So I just deleted that. I've taken that out completely because we're not going to generate any revenue in this business over the next 3 months. Then what I did was I applied, using this box here, is I applied 75% reduction in sales for the next 6 months. So I just put minus 75 in. And what that does is that applies minus 75% right across the board. So then for the remaining 9 months, I'm 75% down. And then all I've done is I've just, over the coming months, all I've done is I've slightly increased that sales figure to be 50% of revenue achieved in the previous year, and then 25%. And then finally, when we get to the following year, we're back to a point where we are doing the same level of turnover, the same level of revenue as we did in the previous year. Now, because it's Excel, you can just put calculations in. So as I've done in this column here, all I've done is I've said, right, we'll take the April figure that I did in 2019 and just multiply that by 50%. So just give me 50% of that. So you can choose whatever you want to do. You can either apply a year-on-year percentage increase, or you can actually just key a number straight in, or you can put a calculation in there. So you can do whatever you want to generate the forecast. But the idea is that at a, in this case, nominal level, we've generated a forecast by line by month for the next 2 years. And then what we do after that, we've got years 3, 4, and 5, where I've just applied the same percentage uplift for all of the nominals. If I want to apply a 10% uplift, I just type 10% in, or if I want to put an absolute number in, I can put an absolute number in, and that will just allow us to forecast that at that level for that particular time period. So I've input my history if I'm not on zero, and I'm then presented with by nominal exactly what my performance is achieved over the last 2 years by month, and I then come on to project by month what I think is going to happen at a nominal level in this instance over the next 24 months. Now, just going to show you, if I don't feel I can forecast at a nominal level or at a customer level or any of that, I could just wipe it out completely, put nothing in for any of the lines, and in this yellow section here where I've got the facility to enter any new sales channels or any new customers, I could just put something like new forecast, and then I could just type the number in. So you can do whatever you want. However, the more detail you go into, the greater understanding you have of your business. I'm just going to undo that. The greater understanding you have of your business, and therefore the more confidence the funder will have in your ability to deliver. So I've looked at my sales. Now the next step would be to look at my gross margin and cost of sales. And we do that by understanding what the gross margin percentage has been. Again, starting off over the last 12 months, so 71% achieved over the last 12 months, compared to 69.6 in the previous 12 months, so therefore 1.4% increase. Then what you're presented with, again in this percentage applied column, is what has my margin rate been over the last 6 months. And it starts off by applying that as your base by month going forward. All I've done is I've said, okay, well, let's just put in April, the margin rate that we achieved in the previous April. And I've done the same across the board. So all I've done there is I've maintained the same margin rate phasing, but different businesses are different, and clearly, you know, sometimes we journal certain things in certain months to cost of sales that may relate to different months. So essentially, you can do whatever you want. You can either enter a number in the yellow box, which will apply right across the board, or you can put an individual number in an individual month. So all we're looking for there is what margin percentage am I going to assume going forward by month, or just put the same figure in each month. So in this instance, because we are closed April, May, and June, we've got a 70.9% margin assumed for year one. Now, I can't type in the actual number for the year. It has to be driven by the addition of the months. Then we come on to the following year, and again, all I've done there is I've done exactly the same. So I've just equaled I've equaled what we did in the previous year plus 0.25%. Again, if you want to, you can key a number in. You can do whatever you want with regards to the margin. The easiest way of generating a margin forecast is using margin percentage, because that directly relates to your revenue and your sales, and therefore you can determine what your cost of sales are very easily that way. You then come on to years 3, 4, and 5, and again just type the total for the year in. So here I've just gone for a 0.4% increase in year 3, up to 72.5 in year 4, and then 73% in year 5. So we've worked through what's going to happen for sales and margin. Next we come down to overheads. Now I've labelled some of these lines and left some just as blank, or called overhead 11 to 40, I think. And then all I've done is just said, okay, well, how would I approach these particular lines within my forecast? So what I've assumed here, if we take gross wages as this line is labelled, I've assumed that for the next 4 months, we're topping up any furloughed staff. So all I've assumed there is our normal monthly expenditure was around about 7,000. Now I've assumed that actually it's going to cost us, so the net that we're going to have to pay is £1,000 a month for the next 4 months, and then we've increased that over the following 6 months to 3,000, and then finally back to the same similar levels to where we were operating from February onwards, and then I've just assumed a flat 7,000 for the following year. So again, we've reflected a downturn in sales. Now, obviously, what I'm going to try and do is mitigate as much of that sales loss in my cost base and keep my cost base as low as possible. Then we've got similar assumptions for other overhead lines. So rent I've left in as being a standard charge every month. So we're still going to continue to pay the rent. I've assumed that IT software and consumables can't be reduced. We're going to stop advertising and marketing for the next 3 months. Right or wrong, discuss. And then we're going to go at half that level for the following 4, and then finally back to a more normal level, whatever normal is from November onwards. So you can see I'm not going to go into each of the details, but what I've done is I've assumed various impacts on various overhead lines for the next 12 months, and then for the following 12 on a monthly basis, and then on an annual basis thereafter. And again, when you're looking at the annual basis, it's either do I apply a percentage increase, or do I type in a number I think I can achieve. So it's just one of the two. If you typed a number in and then you type a percentage in, the percentage won't impact the column. So I will just now go back and look at one more element of the overheads, which is, if I can just scroll back, which relates to lines where you will see in the percentage applied column a minus 100%. So the reason it's put a minus 100% there isn't because you won't be recognizing any corporation tax, or you won't be recognizing any depreciation within your P&L. It's that this tab isn't the tab that you do it on. So those assumptions come in future tabs. So the assumptions for corporation tax, depreciation, and interest, I believe they're the only ones, are essentially taken care of in another part of the model, which is why you'll see minus 100% there and minus 100% there, and if I remember rightly, minus 100% there, because those assumptions are on your three-way forecast tab. So I've gone through, I've set my sales, my margin rate, and my overheads, and then the only other thing I need to do on here, if relevant, is understand any bad debt implications for this business. Now, if there are any bad debt implications, you may well have a line in your P&L called bad debts that you might want to forecast on. In order for it to have the required impact on VAT and accounts receivables, you need to include any bad debts on this specific bad debt line. And again, there's a tooltip on the line. If you go back, there's a tooltip on the line which tells you exactly why I need to put it on that line. So all I would say is wherever there's a red triangle, just hover over it and see what it says, and then you'll understand exactly what you need to do. For this business, I've assumed that there's 35 grand's worth of bad debts, which is going to come in from June to September. And that will therefore ensure that it flows through to the VAT and the accounts receivables calculation. So what I'm left with is I've got a business which over the last 12 months has made £214,000, which was a sizable increase on the previous 12 months, where we achieved 173, to now going to make a loss of 134,000. I've seen quite a few of these prepared and that's not dissimilar to what a lot of the forecasts that I've seen are to where they're coming in at. So I'm going to lose 134. The following year, then I'm back to a point where I'm making, you know, a healthy profit, but all I've really done is made the profit that I lost in the previous year. So for the next 2 years, I'm basically going to stand still from a profit perspective. And that's the reality that a lot of businesses are faced with. And then I've got some growth in my business to get me back to a point where I'm making over 200,000 by year 5. So that essentially has got all of our history for 2 years. It's got our forecast by month for the next 24 months, and then it's got an annual forecast for years 3, 4, and 5. So that's my baseline, and that's what I expect to happen in this business over the next 5 years from a P&L perspective. Now, that's obviously not from a cash or a balance sheet perspective. So in order to bring those elements in, we've got 2 further tabs with regards to baseline. So we've got the balance sheet, and this one's quite simple. I take my balance sheet line, so it's either a current asset, a current liability, or a long-term liability. Fixed assets are accounted for separately. And then I just assign a treatment. Now, it should be fairly straightforward with regards to the treatment that I assign. And again, you just select it from the drop-down. You've got your options on your drop-down, and then on your notes tab, you will have what each of those means. So if I select something as cash, the account line will roll up into the closing cash total. If I assign a line as VAT, so the account line will roll up into the closing VAT payable total, and therefore the VAT payment calculation. So it tells you where each of those will roll up into. I mean, 9 times out of 10 it will be pretty self-explanatory. And you may have, you know, numerous nominals which relate to the same category, so numerous payables nominals and VAT nominals. In this instance, we've got a bank account, we've also got a PayPal account, which are technically both cash. Where you want a nominal balance to remain the same throughout the course of the model, and therefore not impact any of the calculations, you just assign it as other. So as an example, my rental deposit is just going to remain the same for the next 5 years. So I'll assign that as other, and that will mean that that balance won't be impacted by any of my other assumptions within the model. So I do that for my current assets, my current liabilities, and my long-term liabilities. So I've set my P&L, I've set my base balance sheet, and now I just need to think about the real the working capital implications on the business. And this is what requires you know, quite a bit of thought with regards to how this might play out within the business. So the first line that I'm presented with is my depreciation, and you remember from the profit and loss from the baseline forecast, depreciation is automatically set to 0, and the reason that's set to 0 is because you put your depreciation assumptions in here. So the model has calculated that over the last 12 months, the average depreciation percentage has been 32.4. Now that may or may not be correct, but that's your start of 10. When I say it may or may not be correct, factually it's correct because it's just a calculation, but actually the number that it's used for depreciation may have had some accelerated depreciation within there. We may have had some asset write-offs, we had all sorts of things that could have affected that number. And if actually I generally depreciate on a 25%, you know, assume that going forward. So whatever your particular policy is within your business, you just put that percentage in there, and that it will just assume that each month going forward. Similarly with interest, all it's doing is it says what's my interest payments over the last 12 months, what was my opening and my closing debt balance, and therefore what's the percentage of interest that I'm paying. Again, a manual journal anywhere can impact what that number is, and if actually that's not 12.6%, I know my loan and it's 9.7%, I just put 9.7% in, and that will ensure the correct interest calculation going forward, and it will apply that interest to anything you classify as debt. So at the moment in this business we've got a £5,000 outstanding bank loan, which is therefore debt. I then come on to my inventory days. So I use this number to essentially drive my stock level. Now in this business, if I just scroll down slightly, you can see I've got £115,000 as stock balance. And that's come from my current assets, stock, and me assigning it as stock work in progress. Not a lot I can do about my stock when I'm closed. Can't get rid of it, can't use it. So yeah, that's going to remain the same for the first few months. And then what I'm going to do is I'm going to start to reduce my stock levels. Now this is quite important because a lot of feedback we're getting from funders is that, yeah, I understand the difficulty you're in, but try and meet us halfway. Try and manage some of the working capital requirements that you're saying you need within your business. In this instance, I don't understand why you're carrying 156 days worth of stock. So how can we get that down? And what you use to drive those that level of stock down are these average stock days here. Now, we're not going to get down to a suitable level of stock turn until the end of next year. In which case, so what we've done here is we've reflected a reduction down to roughly 80 days stock, which will drive a number within the balance sheet, which is around about £50,000. So we just need to think about how we can assist, because if you just maintain the same number of stock days, all it will assume is that whatever your cost of sales is, then that's a cash outflow in the business. But actually in this business, we've got a lot of stock already there, so we can look to utilize some of that. And that's how, and in this example, that's how you would accommodate that. Then we come on to tax, because tax is a really important one, because you'll have, you know, the timing between when you actually recognize the corporation tax and when you actually pay your corporation tax is drastically different. I'll assume a March year end for this business. Let's assume we've done our year end and we've raised, as we know from our balance sheet, we've got a £15,000 corporation tax liability. Now I'm not actually going to pay that until December, or I may have an agreement with HMRC that I pay a small amount each month, or it may well be that I'd have to pay anything for the next 12 months. So dependent upon the business, depends on what you put in. Essentially, this row here is for when you recognize a tax liability, and the row below it is when you pay that liability. So in this instance, I know I've got £15,000, and I'm going to pay that in December. So I put that £15,000 there. And then what that will do is, again, if I just scroll down to the balance sheet, just so you can see the impact, you will see that I've got my £15,000 liability, which maintains in my balance sheet until I get to December when I paid it, and then it's gone. Now, what I then need to think about is my next 12 months and any tax liability that arises from that trading period, because I'm going to put it in March in this instance. I could do it on a monthly basis. I'm just going to do it at year end in this instance. Now, as I've lost £142,000 in that year, there's going to be no corporation tax liability that I'm going to raise there. So I then go on to the following year. So I'm not going to pay anything in December of the following year because I've not got anything to pay. And then I'm going to get to March, and I've made profit before tax of 147. So essentially, my profit in my year two is just offset my loss in year one. So I've assumed, because I'm lazy, that there'll be no tax there, because the guys will do their work and make sure that you've got no tax to pay. Then all I do is the following year, I then make a profit in the following year. So there will be a tax liability, in this instance, 27,000, which I'm going to pay in the following year. And in that year, I raise another tax liability, which I pay in the following year. So hopefully that's straightforward. But again, any questions, then we're more than happy to answer them. Then for the owner managed businesses, the most important bit, which is any dividend payments. So again, we don't recognize dividend payments on the P&L within the forecast. They are recorded on our Threeway Forecast tab. So in this instance, what I've assumed is that this business owner requires £1,500 a month. So that's why I put £1,500 a month in here. Again, if that's 3,000, then you just key in 3,000. It will tell you generally in the notes section if you enter a number as a positive or negative. And most of the, so generally any outflow is positive and any inflow is a negative within the model. So I've got my 1,500 quid a month for the next 12 months, which is going up to 2,000 a month for the following 12. And then annually for years 3, 4, and 5, we've got 30,000, 36, and then 48. So there we are reflecting the dividend payments to the owner in this instance. Then I have a section on capital expenditure. So again, this is planned capital expenditure within the business. Literally all I've assumed here is that every year there's a 20 grand capital expenditure program that happens every September. So we've got 20,000 in September, 20,000 the following September, and then 20,000 each year thereafter. So that's planned capital expenditure. And then I deal with any outstanding debt. So this isn't any funding that we're after. This is our outstanding debt within the business. So here we've got this £5,000, and all I've assumed, this is the capital element. So we've already dealt with the interest up here, and this is the capital element. And with this loan, I've just assumed here that actually we've only got 1 month left on it, and that will be paid off by the end of April, which is why I've put minus 5,000 in there. And then you'll see on your balance sheet, you'll have your debt, which was at 5,000, and there's now no debt in the business as of April going forward. If there's any equity issued or share buyback or repaid, then that can be accounted for in the equity line. So I don't know, there may be somebody that's going to invest in the business with a sum of cash to help you through these difficult times, in which case you just record it there if it is for equity, and that will flow through to both cash and shareholders' equity on the balance sheet. So these are important assumptions because they impact the working capital requirements of your business. So although we've got a profit figure that we've set on the balance sheet and on the P&L, and we've got a profit figure by month, actually these are the important assumptions which then relate that profitability to our working capital requirements, because that's the real impact, because that impacts the cash in the business, and that's what's the most important thing at this point in time. So I'm going to go down to our main 3 assumptions now, which are VAT, accounts receivables, and accounts payable, which are generally our main 3 working capital assumptions within the business, other than stock. So at the bottom, apologies, I'll just scroll up. At the bottom, we've got our VAT, receivables, and payables schedule. Now, what we do here, the first section we look at is VAT. And again, you've got these tooltips everywhere. So all you need to do is hover over, and it will tell you what you need to do. So the first thing we need to do is enter our average output and input VAT rates, because this is the percentage that's going to be applied to your sales in the case of output VAT, and your cost of sales and overheads in the case of input VAT. So on average, and I've assumed that this business operates everything, that every output is VATable, so 20%. Again, you're given a guide. So in the notes section there, so the approximate output VAT can be calculated by dividing box 6 on your VAT return by box 1. And then input VAT, again, there's a similar comment for input VAT as well. So here I've assumed 20% output VAT, which is everything we sell is VATable, and then a 17% input VAT rate. Then what it does is it takes your VAT cycle. So I tell it what VAT cycle I'm on. I'll stick with January, April, July, and October, and it will assume that whatever VAT is outstanding at each of these months is paid in the following month. Now, sometimes I know that's paid, there's another month before that's paid, but it does depend on the business. So some businesses do their return straight away and pay it, and some businesses wait as long as they can to do their return and pay and wait as long as they can to pay it. So the assumption here is that it's paid the month after the cycle it relates to. However, you can change that. So I'll just go through the quick calculation with you. So I've got my opening VAT balance, which is the balance again, which was on my balance sheet here, which is essentially this VAT liability line here. So that's my outstanding balance that I know I've got. I then go through and I say, okay, well, I've got my opening balance. What's my VAT payable on revenue? Well, none, because there is none in that month. What's my VAT recoverable on my expenditure? So I know there's expenditure within that month, and I'm applying a 17% to that expenditure. So what's my net movement in the month, which is minus 2,200. So my rolling, so my new balance is going to be 9.5. And all it does is it maintains that calculation going forward. You'll see you'll see you've got payment assumptions in the individual months. So if that's not relevant, so as an example, let's say I've got a 12-month VAT payment holiday. All I do is I go across and I delete the numbers out for the next 12 months. And then all it does is it just calculates what your balance is at any point in time. Now you'll see with this one, because we're doing hardly any revenue for the next 4 or 5 months, and we are still maintaining a certain cost base, actually our liability is reducing over a period of time. And then as we start to increase our revenue and we start to get back to a normal level of trading, then it will increase again. So actually, when we come to paying our next level of VAT in May, we actually only owe £1,765 because we've been so severely hit from a revenue perspective. And we've made £140,000 loss in that year. I'll just undo that and just leave the normal calculation in there. So again, if you change your VAT period, that will just change the timing of the payment. If I'm on a scheme where I just pay a set amount, if I'm on a VAT repayment scheme where I just pay a set amount each month, I just put that set amount in there. So if that's £1,000 a month, I just put £1,000 a month in like that, and I just disregard the calculation that's in there. So every calculation that you're given within the model is just the starter for 10. You can anything that is blue, you can just overtype and put what you want in there. So that's the VAT. Now we come on to receivables. Now the assumption for this business is it's a B2B business, and it's in the events industry, as we said. So the likelihood of maintaining a good level of receivables over the next few months is very, very rare. So what we're assuming here is the percentage that we input in this row gets applied to what's our opening balance for receivables, and then what receivables have we generated in the month, less bad debts, and therefore what are my total receivables, and then the percentage gets applied to that number. So what we've assumed here is, so we've got our opening receivables of 76,000 in this business, which is this number here from my balance sheet, where I've said, right, this I want to apply my receivable treatment to this line. That gives me that figure, and then I assume a percentage of that figure of my balance that I'm gonna receive in that month. Now in this instance, I've assumed only sort of 10% for the next 3 months. So only 10% of my receivables are going to be recovered in the next 3 months. And then I'm slowly going to build up, because most of my customers are in the same position that I'm in as a business, and therefore they're unlikely to pay. I've already accounted for my bad debts, i.e. my £30,000 bad, £30,000 bad, 35,000 on the previous screen, and you'll see they come through here. So this line is my revenue less my bad debt. So there's my minus 10,000, which was 1 month. I think there was 10,000 there, 10,000 there, and 5,000 there as well. So it adds that into your receivables. So as you recognize it as a bad debt, it comes off of your receivables. So finally, you're given an amount which you receive in the month, and then what we've assumed in this instance is actually we finally get back to a position where we are recovering, around about 50% of what we're owed at the end of the month in the month. what you've got down at the bottom is you've got an understanding of what that actually means from a debtor or accounts receivable days. So we can see we were operating at about 30 for the year up to the point we're doing the forecast, and we don't actually get back down to that point until the end of year 2 in this instance, and we're at our worst where we're actually up at around about 130. So in December of this year, the 12 months up to that point, we're up at around about 130 debtor days, purely because people aren't in the position to be able to pay. We then follow the same approach for payables. Now, again, what I've assumed here is we will reduce our payables, so we're paying 25% of our opening payables plus any payables generated in the month. Now, I've assumed slightly higher than our receivables because some of those might be on direct debit and we might not actually be able to decide whether we do or don't pay them. And ideally, we wouldn't want to put other businesses in a similar position. So I've just assumed there is 25%, and then finally we get back up to a point where we're operating at around about 30 receivables days as we were previously. So appreciate that was a lot to take in, but what we've done there is we've set our baseline forecast in our P&L by month for the next 24 months and then annually thereafter. We've classified our balance sheet, and then we've input our key working capital assumptions, all really to drive one line in our balance sheet, which is our cash. So we can see that we start off with a cash position of 34,000, which, if I just go back, is my 34. It's these two lines here on my balance sheet. So I've classified those as cash. Then, through the impact of lower revenue, lower cost, but still a cost based, disproportionate to that revenue. We've got fewer people paying us, so our receivables are our receivable days are increasing, and the impact managing to mitigate some of that in our payables. We're actually getting to a point where our cash position is going from 34,000 down to as low as 150,000 by June of next year. So we're in a position now where, although in our P&L we only had 1 month where, it was only the next 12 months that was generating a loss, and after that we were generating a profit. Actually, you can see that you don't come out of that until December of the following year. So that's going to impact this business, and again, it's not that's representative of a lot of businesses, but it's going to impact this business right up until December of next year. And this is the sort of understanding that the funders are going to need to be able to say, okay, well, right, I understand what money you need. I understand why you need it. So we'll come on to how we account for that next. So we've set our baseline. We know we're in a position where we need at least 150, 160,000 pound. But we've also, within this business, we've also found a way of generating revenue in the short term. So and what this revenue generation is going to relate to online virtual events. In order to be able to offer those virtual events, I need to invest, and I need £50,000 to do that. So what we do is we say we take the funding, and now we say what impact on our business is the funding going to have. So we get our funding forecast, which is laid out exactly the same as our baseline forecast, and it pulls through. I'll just go back. It pulls through all of the information that was on our funding forecast. Sorry, that was on our baseline forecast, and it says, this was your baseline for this particular nominal for year 1. What impact does this funding have on each of these nominals? So if it's going to have if your investment is going to have a 5% increase across the board, you just type 5% in there, and what that will do is that will apply a 5% uplift to your baseline forecast. We're not going to do it that way. What we're going to do is we're going to identify it as a new sales channel. So what I've put down here this is your area to just input any additional sales categories. Is we've got new website stroke portal, which is going to deliver us £1,000 when we launch it, and that's going to grow going forward. So this new element of activity is going to grow up to about £10,000 a month by the end of the year. Then that's going to generate £10,000 a month going forward for the following year. And then all I've done is I've input the actual figures for years 3, years 4, and years 5. I've just input those in these blue cells here. And then what you get at the bottom is an example. So as an example, in year 4 of our scenario, we had originally our baseline, we had 918,000. Now with our increased sales, actually we're up to almost 1.1 million. And that's the important bit to show, to be able to articulate to the lender exactly the impact that investment's going to have. So we've done that for sales. I'll very, very quickly go down to margin. What I'm going to assume there is actually we can generate this revenue at a slightly increased margin rate. So you know, let's say 2% or 1% as I have it. So all that does is applies a 1% increase to my baseline assumption, and then all I've done down below is I've assumed additional costs relating to the project. So here I've got, and that's now going to cost me an extra £5,000 a month going forward. So what we've done is we've got to a point where we originally, once we've rolled everything through, had a net profit of that's the percentage, a net profit of 134 in our baseline where we set it. As a result of this, as a result of the new activity, because of the investment, actually, because of this large operational cost, initially we're going to make even more of a loss. We're going to go down to £150,000 loss, but then after that, we're going to, you know, where we would have made 158 the following year, that's going to increase to 189, etc., etc. So I've input there. So we know we've got a cash problem in the business. If we want to invest in the business and drive it forward, we input the impact that has in our funding forecast. Then we move on to our three-way forecast, and we just input the investment that we're going to need. So you'll see everything else has just been pulled through from our baseline. So we don't have to do any of that again. All we do need to say is that, you know, this would appear. So that was our baseline. So exactly everything as we had it. Now all we're going to say is, well, okay, well, in order to produce this new portal, we need £50,000. And now we can go down and say, right, okay, if I look at our cash position now, based on our revised profitability, based on our cash requirement of 50,000, we're going to need £230,000 minimum in order to generate that. So then what we do is we go up to our debt line and we put in, I'll put 250, £250,000, which is the debt that that's going to be required. Now I'm assuming here that we're going to take full advantage of Receivables, where we can get 12 months interest free and also no lender levied fees, and also not start repaying it for 12 months. So all we do there is I wipe out that interest rate over the next 12 months. And let's assume this loan's at 5.7%. And then I don't start repaying the capital until June as well. And then I start that on a monthly basis going forward. So this is in year 2 by month, and then years 3, 4, and 5, there's my capital repayment. So at the end of year 5, I'm in a position where I've got a lot more cash in the business now, and my outstanding debt is at 58,000. So I've not repaid that debt in that time period, because I've taken it out over a slightly longer, over a 6-year period, and only starting payments of those at the start of the second year. So there's still some debt within the business, but my business is in a much healthier position. So what I've tried to do there is, of course, if we are just applying for a receivables loan, which to facilitate a cash flow deficit, obviously we'd have none of this on here, because your baseline forecast would be the same as your funding forecast. The business's profitability would be exactly the same. The only difference would be the number that you type into this cell here. So then what we do is essentially we generate the funding proposal. And what I've done is I've got one which I saved earlier. So there's I don't know why the button's gone on this one. There's a button here. Ordinarily, there's a button which you press which says generate funding proposal, and what that does, so I've got one which I've prepared earlier, and what that does is that provides you with the functionality, just opening it up, that provides you with the functionality to create a funding proposal. So what I'll do, I'll just open that one up. So what we have is, so the button's there, it says generate funding proposal, and it essentially creates a document for you. And that document, if I just select the print layout, is a 6-page document which goes through everything the funder will now need to know about that business. So you press that button that you can't see but will be there, and that will generate this document for you. And when you get the document, these 2 cells will be empty, because they're for you as the business owner to enter the information that is required. So executive summary, how much is being requested, why do you need it, and what will it be used for? Company profile, give the lender a sense of your business's history, talk about the sector it operates in. You know, if there's any other relevant information, input it there. So all I've done is just made some stuff up for this one, and just input it in the cells provided. And this is one document which therefore gives all of the information. They use a process and methodology called Campari. So not only do they take the quantitative, the numbers which you've provided, they also take the qualitative information about the business, about the owner, about the management team, to give them some comfort in your ability to actually deliver what you say you're going to deliver. Then you've got a section on the financial performance. So again, this is all pre-populated, this section, and you can choose to stick with the wording, or you can choose to just type in whatever you want. We're going to stick with the wording for now. So this is there, and again, going back to the however much history you've entered, or however much history your business has got, will be reflected here. So in this instance, we've got 5 years worth of history, and that's all presented in the history here, talking about my revenue, my margin, and my profit over the last 5 years. And then finally, the net worth of the business as it stands today, just covering the key balance sheet areas of fixed and current assets, and then total liabilities. Then we talk about the seasonality, and this is all history. Remember, this is just setting the scene for the lender. Talk about the history of the business, the seasonality over the last 2 years for both revenue and profit. And then we come on to the SWOT analysis, a really important part for you to complete as the owner. Again, you've got the tooltip here to the right hand side. So none of this section appears on your actual document itself, just the boxes and the information you've completed. But again, yeah, you only need 3 to 5 points per section, but really important to talk about the internal strengths and weaknesses and the external opportunities and threats that are apparent within the business. Then we finally come on to the actual funding requirements. So we've already set the scene of the business, talked about its performance. Hopefully the lender's in a position where they can see actually this was a profitable business. It's got good history. It's strong, solid business. We then, we need 250,000. What do we need that for? Well, 180 of it is to satisfy the short-term cash deficit due to the COVID-19 pandemic. 50 of it was for the creation of a new e-commerce website. Pardon me. And then 20 of it is for a contingency. So be clear, be specific. Don't be, don't go down to a granular level of detail, but give the lender a sense of exactly what it is you're going to spend the money on, and just make sure that the totals add up. That's the first thing they're going to look for. Then we've got some information which is automatically populated from the forecast post funding. So we will talk about and articulate the impact the funding is going to have on the business. So this is the key element they're looking for. So as a result of the investment, we know that our average sales are going to go up by about 18% a year. Our margin percentage will increase by 1%. So that's that 1% I added. In turn, our gross margin cash will increase by almost 20%. Overheads are expected to increase as a result of that £5,000 a period, or £5,000 a month we put in, by 17.8. So when I add all of that together, this will deliver an increase in profit of almost 80,000 by year 5. So it's just putting into words what the numbers are saying. And then the important bit from a business continuity perspective is our cash flow is also expected to increase from minus 150,000 in our baseline to our lowest point of 16,800 in our forecast scenario. And then the amount of outstanding debt at the end of year 5 is expected to increase by £58,000. Then if you want to, you put in the assumptions you've used within the forecast itself, and then we've got some graphs which talk about the different scenarios. So my baseline scenario and my scenario with funding. So for revenue, for profit, cash, and net worth. So the important piece here is next year I'm now in a position where I don't have a cash deficit, and in year 2 I've got considerably more cash than the borderline cash I had, or I'm expecting to have. So that's showing the impact that the funding is going to have on the business. We then just reflect the next 2 years by month going forward, and again, all of this is just produced for you when you click that button that you couldn't see, but will be there. And then that generates the next 24 months phased for revenue and profit. Again, we can see here where we're basically closed and not making hardly any revenue. Then a section for any other information that I might have, and then finally your appendix, which has got your more detailed profit and loss over the next 5 years, balance sheet, cash flow statement, and then supporting schedules to back that up. And then finally, Appendix 3 has got, if I want to detail anything I've got on my any of my fixed assets, I want to detail any of those. And then importantly, as all, well, they'll know anyway, but as most lenders look for is, an understanding of what existing debt you've got within the business. So just a clear understanding of, yes, I've currently got a £5,000 balance on my balance sheet, and then just some information about that loan. So hopefully you'll see. Now I've gone through that really quickly, but with a bit of thought and a bit of understanding with regards to how do I articulate this performance. I talk about my baseline performance, i.e. what I know is going to happen in this business. I then talk about the impact that the funding can have on the business, either from a P&L perspective and a cash and balance sheet, or just from a cash and balance sheet perspective. That then produces a funding report, which I then fill in a few boxes and then present. And that gets over the problem, which Mike said right at the start, is actually, if you're going for a loan of any value, you're going to need all of this information to give the lender comfort and not get a long period of waiting where they're going through and asking more and more questions. So thank you for your time. I've spoken far too much. I will now hand you back to Mike, so I'll stop sharing my screen.
Thank you, Mark. As I warned you right at the beginning, that's pretty. So you're looking frazzled there. go through that. So I like Martin's comment. No, it would be totally wrong to stop marketing. So a cry from the heart there. But you understand the principle of what that is. So you start with the base now, where we've got zero. Obviously, we just take it all there. So the base is there. QuickBooks we're going to be able to do in July, Sage in June, and we just we'll take all the base information, and then we can, once we've got that base information, we still then have to go through all those scenarios. So we've got to look and do the what if and identify, right, if the sales are going to drop off the cliff. So, we've got several clients who are in the hospitality world up in London. They're just planning that there's going to be nothing this year. So if they've got any events, it's going to be very lucky. So they're just planning now to say, right, okay, everybody's furloughed, so they've just got their fixed costs, which they're negotiating on, and they've got to then plan ahead. So a couple of them are even thinking, do they close the business? So the point is, if you're going to go for funding, you're going to need to explain your assumptions, and they've got to have to. If I was the lender, I've got to be convinced that that you know what you're talking about. And so just by saying, oh well, look, I need 100 grand, without any assumptions behind it that you can show, just means that you don't give any comfort to the lender. So as Mark went through, and he's just saying, look, all these different assumptions, whether you pay the VAT, whether you defer the VAT, whether you furlough the staff. On some businesses, with that latest furlough extension, it could be that we actually use those extra overhead criteria, and depending on the number of staff that you've got in the business, you could actually put down I saw one example where they were detailing each member of staff, and so they could actually show what the cost was, which was furloughed, when they were bringing them back, and so you can go to that level of detail. But whichever you do, it's never going to be right. It's always going to be an assumption, but at least it's an assumption that's shown that you've thought about it and that you've got a system that makes sense. And that's really what we're trying to do, because as I said right at the beginning, our concern is not just this initial phase this year, is will we have the right funding